Hello and welcome to Aasgard Updates, episode number 3. Today is going to be a long one. I'm going to be taking you through our pitch deck, and we're going to talk about how we select stocks and how we put together portfolios. Quick caveats: this is not financial advice, and this is not a solicitation for investment. If you have questions or comments, feel free to reach out to us and contact us, and we'll help you with whatever you might be facing in the financial world. So I'll go ahead and get started here. A quick outline. I'm going to go over basically what the basic Aasgard strategy is. How do we select stocks, and the 5 primary factors that we look at when we're evaluating businesses. And then we're also going to talk a bit about portfolio construction and how do we, after you found the perfect stocks, what constitutes a good portfolio of stocks. So to begin with, stock selection, in my opinion, it's an information problem, right? There's billions of pieces of information about every single business. And there's this continual flood of information that's coming out every single day. And can you possibly evaluate all of it? Well, one, it's impossible. A manager, basically what we have to do is create a funnel and create a filtering process, and figure out whether or not what the information is and if it's accurate, right? Don't believe everything you hear on the internet. Don't trust every YouTube video that you might watch. You need to figure out if the information is meaningful, right? Is it going, and is it predictive? Is it going to actually impact the price of this company on a forward basis, right? I mean, is it even actionable, right? You found this piece of information. Does this mean it's a good company historically, or does it mean it's a good company going forward? And so you have to figure out whether or not these things are predictive. And so information can be put through this funnel and basically narrow down to pieces of information that we can actually use. And so there's a couple of popular ways of putting together a portfolio of equities, and the most common, and you've probably encountered, if you've picked up an investment book or you've gone onto the Morningstar website and how they evaluate managers, what they're typically looking at are managers that are using fundamental analysis to determine whether a company is a good company or bad company. And so the typical process is you hire a bunch of analysts and you try to cover as much of the universe as possible. Or maybe you create a niche that you're trying to exploit, a sliver of the market. But generally what you're doing is you're going to try to capture all the important information. You're going to go through that kind of funnel process and say, oh, is this, what information can I use? And can I develop an information advantage over the market, right? So if you're good, if you have a great analyst, you can create a mosaic of all the information out there, and maybe you can divine some special insights that the market's not quite pricing, right? Is this company about to inflect into a new business segment? Are they going to grow their operations? Or the inverse? Are they losing a major customer, right? And maybe the market hasn't quite figured that out yet. So a good fundamental analyst is going to be able to find those kind of opportunities, right? And the pros to this is, like, if you actually uncover unknown hidden information out there, you can exploit it, right? If they are going to grow into this new segment and the market hasn't priced that in, you buy the company, it enters that market, their earnings start increasing, and then people start to figure it out, and then they price that into the company. And so you can win, you can get a home run. The cons on this is, you're going to miss a bunch, because if you're focused on one thing, there's a lot of other things going on out there in the world. And if you miss them, you're missing other opportunities out there in that universe. The idea of a random walk, right? Information advantages appear, if they do appear, they happen rarely. And, if you look historically, most managers following this approach don't beat the index, right? You've probably seen those stats where, active managers tend to underperform. Well, they underperform generally by their fee. and also just over time, this information advantage they might be able to find at one point in time, they might not be able to find it again. And, in this business, if you're not winning every quarter or every year, you could be out of favor for a little bit, but, if you're out of favor for 3 or so years, people lose patience. And even though you might be a great manager, if there's just no new information to exploit, you're going to lag. And, in that situation, that your host relative to the index. And so, these kinds of managers, they tend to have a large tracking error, and meaning that they can outperform for short periods of time, and they can underperform for other periods of time. And that can be frustrating for a lot of investors. The other approach is to straight buy the index, right? And so when you're buying an index, what you're doing is you're observing the market, and then you're going to buy all the companies, some representative sample or all of them, all the companies in that index, and you're going to own them proportionally relative to what the market has priced them. And that's a pretty fair approach. And if you do it, it's going to be very cost effective. And the cons on this approach, though, is that you're never going to outperform. You're never going to have that heroic moment. Oh, look how great this strategy is. We're outperforming the market. Not going to happen when you index. You're always going to underperform by the level of fees, right? So if you're paying any fee, which is all products in existence have some sort of fee, it's just the frictions of buying and selling the companies, the commissions involved in that, and then the management fees themselves, you're going to underperform that index over time. And when you buy the index, you're buying all the losers too, right? There are a bunch of companies out there that are going to fail, right? Your next Enron, your next WorldCom, Pets.com, you name it, it's in the index right now. There are bad companies out there, and well, if you can weed them out, you're probably going to outperform. So maybe you don't want to just straight index. And you can also get bubbles, right? If you remember 1999, speculative excess investors essentially borrowed a lot of money on margin or in other ways, and they bought the stock market, and you can see, the overall valuation levels in the market were elevated relative to history. And then, the Fed in 99, they took away the punch bowl by raising interest rates, and the music stopped. And then, so the market corrected about 50%, when all was done. So, indexes aren't perfect. You can get trapped into a bubble, and you can see pretty major declines so if you buy at the wrong time, and then the market mentality changes, you can lose a lot, right? The value of that investment can decline. And we've seen in historical recessions generally about 50% to 60% off. But it goes the other way too. And then not all indices are the same, and not all economies recover. I mean, if you look at the Nikkei, you've got multi-decades of no new highs, right? So you basically just have this kind of echocardiogram where you just go sideways trading up and down. You have these big, giant multi-year swings with no advancement. In the U.S., we've been very fortunate that our indices have grown. Our economy in general has grown, pretty much perpetually over, the last 100 years, absent, the recessions that we've had. And then there's this kind of third approach out there. It's called procedural stock selection. And in this approach, what you're looking for is you can analyze different groups of stocks over time, and you can break them down by attributes, right? There are some companies that tend to, relative to their peers, grow faster, grow their revenues in particular, for their sales growth is faster, their earnings growth is faster. Value companies, those are companies that, either on some price multiple, so maybe a price to earnings, price to sales, price to book, on those values, on those attributes, they tend to trade less than their peers. That has been a source of excess return over time. If you just took that basket and you owned it over some large period of time and you rebalanced over time, you've generally outperformed the stock market. Likewise with the growth companies, companies that grow faster tend to outperform the stock market over time. And there's another category called momentum, and this is works generally in the short run, but companies that have literally just outperformed their peers in stock price appreciation over the prior 3 to 12 months, depending what time frame you want to look at, tend to outperform over the following subsequent 3 to 12 month period. And that's been relatively persistent over time. Now you get major inflections on that, but the general idea is you could break down the universe of companies based on these kinds of attributes, and those groups have outperformed generally from time to time, but just not consistently. So because if it was easy, it'd be easy, but they do tend to perform over time based on these attributes. And so you may have heard of the term smart beta. There's a lot of products out there that use this approach, and they're usually focused in on a single one of these attributes. Quality is another one that you might find from time to time. And so, the pros of this approach is that, it'll offer a pure expression of a known factor, right? You can say, hey, look, I know value companies, given a long enough period of time, will outperform the stock market. No is a strong word, but that's the idea. you can just go out and buy the value companies, right? Likewise, you can buy just the growth companies, and you generally have confidence that they will outperform the market over some period of time. And the pros, you're going to exploit those characteristics of those good companies in aggregate, but you're going to, and so you're going to miss less opportunities, right? So you're going to be capturing a broader swath of good quality or good growth, what, name the attribute. And it's less labor intensive, right? You don't need a team of analysts to do this. You can just data mine this out. The cons, because you're going to spread your bets a bit more thinly with this approach. It's kind of a quasi index. Your portfolio weights, you're not going to get a giant home run, generally speaking, because you're going to have this, like I said, you're going to spread your bets out quite a bit. And each of these attributes will underperform from time to time. One of the things, everyone wants to be always winning at all times, but that's not how this works. When you're picking one of these factors, or you're expressing one of these factors in a portfolio, generally speaking, at any given moment, one of these is going to be outperforming the other, and that happens essentially at random and based on investor preferences, which are fickle and change in an unpredictable manner. So our approach, it's a bit of a blend. What we're doing is utilizing a procedural stock selection, but we're also putting on a bit of an active fundamental twist on it. And so I want you to think of what the ideal stock investment is, right? If you were, you had to concentrate all of your bets into a single company, a single stock, how would you go about doing that? Well, in my mental framework here, what we're looking for is a company that has fast revenue growth, right? It has an innovative product or service, and that truly adds value to the customer experience. Like, you're really helping your customers, which engenders customer loyalty and more customers, right? They tell their friends. The products sell themselves. Like, that's the kind of idea that you're looking to capture. And in this fast-growing company is either growing into a new market, right? This is Apple creating the iPad and the iPod and creating a whole new segment of business, or they're taking market share, right? Like, their product is so good, nobody else can compete. So that's a good company, right? So now you've identified a great company. They're growing their sales. They're capturing their market. But you also want to marry that with what we believe is disciplined management, right? You want the management team to be good stewards of the company. And so one way you can kind of figure that out is if they're paying a consistent growing dividend, right? They're rewarding shareholders. They're not doing it just for themselves, right? So in a good management team, they're looking out for their shareholders. And so you can see that displayed in how they behave with the earnings, right? They're building an empire, and they're gilded offices and private jets and that kind of thing, political donations, those kind of things. They're essentially wasting the earnings of the company. A good disciplined management is going to share those earnings with their shareholders. A good company, this ideal stock investment, again, is going to be trading at a low valuation, right? It's cheaper relative to everybody else. Not only is it a great company, but it's also super cheap. That's fantastic. That would be ideal if you could ever find that. It happens transitory, but you'll find it every once in a while. And then you also want to see it expressing positive momentum. Basically, what you want is a low valuation coupled with the market starting to reward that business, and you can literally see that in the stock price as it's behaving relative to its market peers. And so, a company like that, with the stock attributes like that, it's incredibly rare. Once in a while, you'll find it, like, when you're in a recession and the bear market, there's more opportunities like this. Or if you're just kind of in a stagnant market, you might be able to find these kind of companies trading in this manner, but it's super rare. But what you can do is you can take these companies and you can use that as your baseline. That's you create this model company, and then you're going to rank everybody else against it. And so it's a point of reference and not a requirement. Like, there's no way you're ever going to be able to build a diversified portfolio of companies like this with these attributes. But what you can do is you can rank everybody else relative to this idealized version. And so if you do that over time, consistently over time, the portfolio itself is going to look and behave like this ideal stock investment while still being diversified. And so past examples, we've been fortunate to pick up in the past, and like NVIDIA, Whole Foods, which was acquired by Amazon, Broadridge Financial Services, and ResMed, they sell CPAPs. And we were lucky to find these businesses early on with these strategies, and they've turned out to be very fantastic investments. It's worked out, but that said, not every business in the portfolio is going to look like that or behave like that. So in the Aasgard strategy, we're seeking to exploit known persistent sources of excess risk-adjusted return with a minimum of tracking error. Meaning, we want to look like we want the portfolio to look like that idealized stock investment, while also behaving in a familiar fashion that a lot like the index. Our portfolios are optimized to express dividend policy, quality, valuation, market cap, and momentum factors. And they're composed of stock companies that outrank their sector peers by our factors. And the portfolios are designed to be sector neutral relative to the primary benchmarks, meaning the industry exposure looks like the index. And our results are basically characterized by lower volatility, greater dividend income, and a low tracking error to the index. And the strategy is best, in my opinion, the strategy is best suited for defensive long-term equity investors that are looking for alpha through a reduction in volatility and in maximum drawdown, meaning just more defensive, and while minimizing the annual tracking error, so you don't get some goofy returns and you're out of favor in most years. And so I'm going to go through some of the factors that we look at, and one of the more important factors in our stock selection process is this dividend policy. And so I'm going to quickly cover how that works. So dividend policy, move my head out of the way here. Doing this all in one take, so bear with me. A simple association, right? Good management principles and a strong culture of corporate governance leads to more durable companies that can adapt and survive through multiple economic cycles, making for great long-term equity investments. Meaning, good management leads to good companies, leads to good returns. That's the observation. So is there an empirical quantitative measure of good discipline? And I would argue that there is, and it's dividend policy. It's the persistence of that dividend, an increase in that dividend, meaning their earnings are growing and they're paying out their proportion of their earnings to their shareholders, and that consistency of that earnings and that dividend growth. So our investment thesis, in short, is dividend growth, dividend persistence, dividend increases within the bounds of free cash flow growth, the stability of dividend growth, all signal strong corporate governance, which leads to superior performance over multiple market cycles, right? Full bull, bear markets, recession, and expansions, versus companies that don't exhibit these characteristics. So some basic academic research on dividend policy. You can pause this right now if you want to read through these, but basically the idea is that dividends are signals. In the top bullet point here, the dividends are signals from the corporate insiders that they expect future profits, right? Companies aren't going to pay out profits unless they think they're going to earn more in the future. So it's this nice positive affirmation that, hey, we're committing to a dividend. That's a strong signal from the insiders. It's also it also exhibits the kind of the agency problem or results or mitigates the agency problem, meaning that it's showing the investors like, hey, look, we're committing to a dividend, which means we're aligned with you, and we're going to enforce some discipline on ourselves by paying this dividend. We're not going to be, our excess returns are going to go to shareholders and not to empire building or gilded offices and corporate jets and political donations and that kind of thing. And then the last bullet point there, basically the idea is that dividends are roughly proportional to the permanent share. So say you earn $100, you're going to feel comfortable paying out $20, let's say, because even a recession comes through, you're going to take a hit to earnings, but you'll have enough free cash flow to pay out 20 cents. So when corporate insiders are setting their dividend policies, they usually set it at the bare minimum they think they can make, even in a bad time. And so it's a nice baseline that you can use to evaluate a company's profitability. So I'll kind of go through this one quickly, but there's evidence in the marketplace, right? So there's this index called the S&P dividend aristocrats. And these are companies that have paid dividends for over 25 years, consistently growing. And it's a small number of companies, not a lot of companies built to pull this off. But in general, that basket has outperformed the market. Now, 2020 is the first time, I mean, the year's not over yet, but in the drawdown in spring of 2020, the dividend aristocrats actually did not outperform the broader market. And that's because investors favored tech. But in historical recessions, this basket of companies has drawn down less, and over a full market cycle has outperformed their peers. We also utilize other factors, mainly valuation and market cap, meaning the smaller the company, generally the better. Valuation, we want companies that are inexpensive, and like I was describing earlier. And we also utilize momentum. We want companies that are outperforming their peers, not just in like their business metrics, but also in their stock market price, because that tends to be predictive, at least over the short run, call it 1 to 3 months time frame. Also talked about this a little bit earlier, but the idea generally is that you can mitigate a lot of risk by relative to an index by making your portfolio look like the index in terms of its industry composition. And so we utilize GICS sectors, but the general idea is the proportional amount of industrial companies and banks and communications companies and tech companies. Those proportions in the Aasgard strategies are going to look a lot like what you're seeing in, let's say, the S&P 500 or the smaller mid-cap indices. And so by doing so, you're controlling for investor preferences that shift, and also economic dynamics that may change. So like right now, everyone loves tech because tech's essentially has ridden through this recession a lot better than, let's say, industrial companies or banks. And because our tech proportion looks like the index, our behavior has looked a lot more like that than versus another manager that's maybe more of a value manager that's allowed to or more inclined to move their sector allocation or their industry sector based on valuations. And so our portfolios, they look awful lot like the index in terms of that industry composition, but the individual components of those are outranking their peers based on the factors, the aforementioned factors from the prior slide, basically your quality, your momentum, your valuation. And so our process, we define the universe of opportunity, we screen out all the non-dividend payers, and then we rank the companies that are left relative to their peers that look like them based on their growth profile, based on their valuation, based on their dividend policy, based on the volatility of that dividend policy. We're ranking them on their quality, what's your return on assets, and how much debt has this business taken on. And then we also look at the momentum, basically a volatility adjusted momentum. And so we're Z-scoring each of these companies, and we're looking at that top quartile, and then we're doing a bit of a fundamental dive and looking and evaluating their business prospects. We look at who their customers are, how are their customers faring, are they making more money or not? Do they have money to buy this product that this company is selling? And how happy are they with that business? And then we look qualitatively at the business management and see if there's anything weird about who they are, their histories and the decisions that they've made. And unfortunately, this is a bit squishy, but when you're deciding between two companies with identical attributes, quantitative attributes, you do have to make a call at some point. And that call is going to be based on a manager discretion, looking at qualitative subjective factors, which is I think unique in our strategy relative to some of the other call it smart beta or other multi-factor strategies that exist out there. And then we have a sell discipline, right? If there's a material change in this business and that we're holding, they've sold. That can happen. But regulatory, if you're getting called before Congress, we're probably going to sell, sell the business. And if there's any kind of malfeasance or what appears to be malfeasance, we're going to sell. Bankruptcy obviously can happen too. And if there's a major momentum swing, negative, right? Company falls off for some reason, they miss their earnings, and it causes us to go back to the drawing board, re-rank, reorder, look again at the subjective qualitative factors, and then make a decision. But generally speaking, if the company's behaving well, we won't sell. But if it's all of a sudden dramatically underperforming, we dig a little deeper, figure out what's going on. Is this a temporary mishap? Is it just 1 quarter of earnings? Just, I don't know. You just got to do the analysis and figure it out. But if something significant has happened to the business, we will sell that. And we also do tax loss harvesting. So simply, if the company's down from its cost basis over 10%, there's an opportunity there to harvest capital losses that can be used to offset future capital gains. We'll take that. And then, growth beyond market cap. Or if this is a small mid-cap strategy, if you float up on market cap, we're gonna sell that company if it just gets too big. And then dividend cuts are also, a major portion of are a deciding factor. If you cut your dividend and it goes to 0, we're going to sell the business. And then also, if it get excessively priced, if we see PE ratios that are well outside the norm, we'll start to sell. And so the cons in this strategy, right? The turnover can be higher, right? If there's a big market decline, there can be major turnover. Some people don't like that. It could be cyclical, right? This strategy is not going to be outperforming at all times. It tends to outperform when the market is weak. It also, and when the market is extremely bullish, it tends to underperform. And that's just the way of life. But this approach, over longer time frames, should outperform, and it has, to date, over a longer time frame. So the more time you give it, the more the dividends accrue, and and the performance, the attributes of these companies can express themselves. But in a big raging bull market where everyone's overbidding for tech, it's gonna underperform. That's just how it goes. And then stock buybacks, they're important, but they tend to be just a temporary position or a temporary component of excess earnings, and not necessarily predictive of future returns. So we don't use that in our stock selection methodology. Well, thank you for sitting through that. If you have any comments or questions, please let me know. You can write in the comments down below, and I can address that on a future call. And if you want to talk to any one of us, www.coldstream.com. We're happy to take your questions. And so thanks for watching, and I'll talk to you next time. Bye-bye.